Studies Section 10, Partnership Accounting 2, Introduction. In Study Section 9, we demonstrated the effect of change in partnership structure, retirement, and admission on the sharing of profit. Another common consequence of change in partnership is the calculation of goodwill, which arises because an existing thriving business is usually worth more than the value of its net asset. In this study section, we shall consider in detail how to estimate goodwill and prepare necessary accounts for change in partnership. Objectives. At the end of this study section, you should be able to 1. Calculate goodwill of a partnership using different methods, and 2. Prepare necessary accounts for admission of new partners as well as for dissolution of partners. Pretest. 1. Define goodwill and state 6 reasons for goodwill. 2. List and explain 3 methods of valuing goodwill. 3. Explain the use of revaluation account and realization account. Content. A. Sources of goodwill. Some of the factors that create goodwill are as follows: quality of the firm's production service, personal reputations of the partners, monopoly enjoyed by the firm, possession of efficient, well-trained employee, possession of trademarks, patents, or franchise, possession of well-known business name. B. Methods of estimating the value of goodwill. The most common methods of valuing goodwill include the following. 1. Purchase of average profit. Under this method, you can calculate goodwill as goodwill is equal to average profit times number of years. 2. Purchase of average super profit. Under this method, you calculate goodwill as goodwill is equal to average super profit times number of years, where average super profit is equal to average actual profit minus normal profit per annum. 3. Capitalization of super profit. To use this method, you will calculate goodwill as goodwill is equal to super profit stroke appropriate rate of return. 4. Excess of net tangible asset. Goodwill is equal to volume of the business minus value of net tangible asset. Example. Rood and Gajah have been in partnership since 1/1/2003. They decided to admit Arrow on 1st January 2008. The profit of their partnership for the year ended 31st December 2007 was as follows. Year 2003, profit 4,000. 2004, profit 7,000. 2005, profit 9,000. 2006, profit 10,000. 2007, profit 15,000. Total 45,000. For this purpose, Rood and Gajah have approached you to help them in estimating the goodwill of their partnership. On investigation, you find that normal rate of return and normal profit per annum in the industry in which Rood and Gajah operates is 15% and 4,500 naira respectively. You are required to estimate goodwill using 1. 3-year purchase of single average profit. 2. 3-year purchase of weighted average profit. 3. 5 years purchase of average super profit. 4. Capitalization of super profit. Solution. 3-year purchase of single average profit. Average profit is equal to 4,000 naira plus 7,000 naira plus 9,000 naira plus 10,000 naira plus 15,000 naira over 5 is equal to 45,000 naira over 5 is equal to 9,000 naira. Goodwill is equal to 9,000 naira times 3 is equal to 27,000 naira. 2. 3 years purchase of weight average. You will calculate weighted average profit as follows. Year 2003, weight 1, profit 4,000, weighted profit 4,000. 2004, weight 2, profit 7,000, weighted profit 14,000. 2005, weight 3, profit 9,000, weighted profit 27,000. 2006, weight 4, profit 10,000, weighted profit 40,000. 2007, weight 5, profit 15,000, weighted profit 75,000. Total weight 15, total weighted profit 160,000 naira. Weighted average profit is equal to 160,000 naira over 15 is equal to 10,666,667 kobo. Weighted average profit is equal to 160,000 naira over 15 is equal to 10,666 naira 667 kobo. Goodwill is equal to 10,666 goodwill 10,666 naira 667 kobo times 3 is equal to 32,000 naira. 3. 5 years purchase of average super profit. Average actual profit is equal to 9,000 naira. Normal profit per annum 4,500 naira. Super profit is equal to 4,500 naira. Goodwill is equal to 4,500 naira times 5 is equal to 22,500 naira. 4. Capitalization of super profit. Super profit is equal to 4,500 naira. Normal rate of return is equal to 15,000. Take 2. Normal rate of return is equal to 15%. Goodwill is equal to 4,500 over 0.15 is equal to 30,000 naira. C. Revaluation of asset. When there is a change in partnership, the partners may decide to reduce the business asset to show the current replacement of the value. The revaluation process may also involve liabilities in some instances. When an asset has increased, decreased in value, debit, credit the asset account and credit, debit revaluation account. When the value of a liability has increased, decreased, you will credit, debit the liability account and debit, credit revaluation account. If the revaluation processes result in the introduction of goodwill, you will debit goodwill account and credit revaluation account. You will transfer the profit or loss on revaluation account to the credit debit side of the capital account at the old profit sharing ratio. Example, admission of new partners. Milo and Mick are into partnership, sharing profit and loss equally. On 1st January 2005, they decided to admit Sugar, who will be entitled to 1/4 of Milo's share. The financial position of the business before the admission of Sugar was as follows. Capital in Naira. Mick, 125,000 Naira. Milo, 125,000 Naira. Freehold premises, 80,000 Naira. Fixture and fittings, 30,000. Stock in trade, 102,300. Debtors, 40,000. Cash in hand, 17,580. Creditors, 19,880. Additional information. 1. It is agreed to value and retain goodwill at 50,000 naira. 2. Other assets are revalued as follows in naira. Freehold premises 120,000, fixture and fittings 26,000, stock 96,000. 3. Provision for bad debt of 5,000 naira is to be made. 4. Sugar is to bring 100,000 naira into the business as capital. You are required to prepare 1. Revaluation account. 2. Partners capital account. 3. Opening balance sheet for the new partnership of Milo, Milk and Sugar. Solution. Revaluation account. Fixture and fittings 4,000, stock 6,300, provisions for bad debt 5,000, share of profit Milk 37,350, Milo 37,350, making 74,700, total 90,000. Freehold premises 40,000, goodwill 50,000, total 90,000. Partners capital account. Milk, Milo, Sugar. Balance 6D. Milk 162,350. Milo 162,350. Sugar 100,000. Total. Milk 162,350. Milo 162,350. Sugar 100,000. Balance brought forward. Milk 125,000. Milo 125,000. Sugar nil. Cash. Milk nil. Milo nil. Sugar 100,000. Share of profit. Milk 37,350. Milo 37,350. Sugar nil. Balance 162,350 on milk. Milo 162,350. Sugar 100,000. Balance sheet. Capital in naira. Milo 162,350. Milk 162,350. Sugar 100,000, making 424,700. Creditors 19,880. Total 444,580. Fixed asset in naira. Goodwill 50,000. Freehold premises 120,000. Fixture and fittings 26,000, making 196,000. Current asset, stock 96,000. Debtors 4,000 to 5,000, 35,000. Cash 17,580 plus 100,000, making 117,580. Total 444,580. D. Dissolution of partnership. Dissolution of partnership means the breaking or coming to an end of a partnership business. The likely reason for dissolving a partnership includes the following: the bankruptcy of a partner, when the time fixed for the agreement has expired, a joint decision to discontinue the business, insolvency of the business. Section 44 of the Partnership Act states that, subject to the partnership agreement, The following orders must be followed for the distribution of partnership assets during dissolution: payment of debt and liabilities to outside creditors, payment of partners' loan, settlement of partners' capital, sharing of profit on realization in their profit-sharing ratio. E. Accounting entries on dissolution. The first entry is to close all the asset account into realization account. To do this, you will credit each asset account except cash and debit realization account. When assets are sold, you will debit cash or bank accounts and credit realization account with sales value. For any asset taken over by a partner, you will debit the partner's capital account and credit realization account. If there are dissolution expenses, you will credit cash/bank account and debit realization account. When creditors are paid, you will debit creditors account and credit cash/bank account. The realization account, the partner's capital account, and cash/bank account. You will transfer the balance in the realization account to the capital account in their profit-sharing ratio. The balance in the cash/bank account must equal to the total amount required to close the capital account. Example: Maslow and Vygotsky are into partnership sharing profit and loss equally. They agreed to dissolve the partnership on 31st December 2007. Their balance sheet as at that date was as follows: capital, Maslow, 10,000, Vygotsky, 20,000, total 30,000. Current liability, creditors, 15,000, making 45,000. Plant and machinery, 10,000. Furniture and fitting, 5,500. Stock, 4,500. Debtors, 12,000. Cash, 13,000. Total, 45,000. The assets were realized as follows in Naira: debtors, 11,000. Plant and machinery, 12,000. Stock, 7,000. Furniture and fittings, 5,000. The cost of dissolution was 5,000 Naira and the creditors were settled with 12,000 Naira. You are required to prepare the necessary accounts to affect the dissolution. Solution: plant and machinery account. Balance brought forward: 1. 10,000. Realization account: 2. 10,000. Furniture and fittings account. Balance brought forward: 1. 5,500. Realization account: 2. 5,500. Stock account. Balance brought forward: 1. 4,500. Realization account: 2. 4,500. Debtors account. Balance brought forward: 1. 12,000. Realization account: 2. 12,000. Realization account. Plant and machinery: 2. 10,000. Furniture and fitting: 2. 5,500. Stock account: 2. 4,500. Debtors: 2. 12,000. Cash dissolution: 4. 500. Capital account share of profit: 7. Maslow 1/2 times 5,500 is equal to 2,750. Vygotsky 1/2 times 5,500, 2,750. Cash 3. Plant and machinery: 12,000. Furniture and fitting: 5,000. Debtors: 11,000. Share: 7,000. Creditors dissolution: 4. 3,000. Creditors account. Cash account: 5. 12,000. Revaluation account: 6. 3,000, making 15,000. Balance brought forward, 1, 15,000, making 15,000. Cash account, balance brought forward, 1, 13,000. Realization account, 3, plant and machinery, 12,000. Furniture and fittings, 5,000. Debtors, 11,000. Stock, 7,000. Realization account, cost dissolution, 4, 500. Creditors, 5, 1, 2. Capital account, 7. Maslow, 12,750. Vygotsky, 22,750. Making 35,500. Partners capital account. Maslow cash account 7, 12,750. Vygotsky 22,750. Maslow 12,750. Vygotsky 12,750. Balance brought forward 1. Maslow 10,000. Vygotsky 20,000. Realization account profit on realization 7. Maslow 2,750. Vygotsky 2,750. Making 12,750 Maslow and 12,750 Vygotsky. 1. Opening of the respective ledger accounts. 2. Transfer of asset to realization account. 3. Posting of sales of asset. 4. Posting cost of dissolution. 5. Settlement of creditors. 6. Posting discount on creditors. 7. Closing the capital account with the balance in the cash account. F. Rules in Ghana 5 Muri. In our last example, the capital account of all partners has credit balance. The sum of the credit balance will just equal to the balance in the cash account. In reality, it is possible for capital account of any partners to have a debit balance. In such a situation, the partner with debit balance in his capital account is said to be deficient and would need to bring in cash to the extent of the deficiency. If the deficient partner is not able to pay by reason of insolvency or bankruptcy, the deficiency will be borne by the solvent partners. Unless there is prior agreement in relation to this matter, the rules laid down in Ghana versus Muri 1904 must be applied. The rules state that the efficiency of insolvent partner should be borne by the solvent partners in the ratio of their last agreed capital. Example: Hicks, Calder, and Tiffin were into partnership business sharing profit and losses in the ratio 4 to 3 to 1. They decided to dissolve the partnership with effect from 31st December 2008. In this course of the dissolution, Tiffin was adjudicated bankrupt and could only pay 16,000 naira 350. The balance sheet of the firm at that date was as shown below. Hicks, Calder, and Tiffin. Balance sheet as at 31st December 2008. Capital account: Hicks 180,000, Calder 45,000, making 225,000. Loan: Hicks 50,000, creditors 75,000, making 350,000. Land and building 120,000, plant and machinery 75,000, stock 24,000, debtors 52,000, capital overdrawn 20,000, cash 59,000, making 350,000. The assets were realized as follows in Naira. Land and buildings, 90,000. Plant and machinery, 60,000. Stock, 27,000. Sundry debtors, 40,500. 5% discount was allowed creditors and a legal charge of 4,950 was to be paid in addition to other expenses of realization of 3,300 naira. You are to assume that the loss or profit on realization of each asset was separately transferred from the asset account to the realization account. You are required to show 1. Realization account, 2. Partners capital account, 3. Cash account. Solution. Realization account. Land and buildings, 30,000. Plant and machinery, 15,000. Debtors, 11,500. Cash, 8,250. Total, 64,750. Stock, 3,000. Discount on creditors, 5% of 75,000 is equal to 3,750. Capital account, X, 4/8, 29,000. Caldo, 3/8, 21,750. Thrifting, 1/8, 7,250. Total, 64,750. Cash account. Balance brought down, 59,000. Land and buildings, 90,000. Plant and machinery, 60,000. Stock, 27,000. Debtors, 40,000. Capital, thrifting, 16,350. Total, 292,850. Cash account. Realization account, 4,950 plus 3,300, making 8,250. Creditors, 95% of 7, take 2. Creditors, 95% of 75,000, 71,250. Loan X, 50,000. Capital account X, 142,280. Caldo, 21,070. Total, 292,850. Capital account X, Caldo, thrifting. Balance brought down. X, nil. Caldo, nil. Thrifting, 20,000. Rent, X, 29,000. Caldo, 21,750. Thrifting, 7,250. Capital, thrifting, X, 8,720. Caldo, 2,180. Thrifting, nil. Cash, X, 142,280. Caldo, 21,070. Thrifting, nil. X, total 180,000. Caldo, total 45,000. Thrifting, total 27,250. Balance brought down. X, 180,000. Caldo, 450,000. Thrifting, nil. Cash, X, nil. Caldo, nil. Thrifting, 16,350. Capital, X, X, nil. Caldo, nil. Thrifting, 8,720. Capital, Caldo, X, nil. Caldo, nil. Thrifting, 2,180. Total, X, 180,000. 45,000. Thrifting, 27,250. Share of thrifting's deficient. Share of thrifting's deficiency. Unrecouped deficiency of thrifting, 10,900. Last capital balances. Take 2. Last capital balances. X, 180,000. Caldo, 45,000. Total, 225,000 naira. Share of thriving deficiency. X 180,000 over 225,000 times 10,900 is equal to 8,720. Caldor 45,000 over 225,000 times 10,900 is equal to 2,180. Total is equal to 10,900. Summary. Change in partnership structure, retirement and admission usually involves the valuation of goodwill. The most common methods of valuing goodwill are purchase of average profit, purchase of average super profit, capitalization of super profit, and excess of net tangible asset. Revaluation account is used to ascertain the net increase/decrease in the value of assets when the partners revalue their asset to show the current replacement value. Realization account is used to ascertain the profit/loss on the net assets of the dissolved partnership. During the dissolution process, if a partner is deficient and not able to pay by reason of insolvency or bankruptcy, the deficiency will be borne by the solvent partners according to the rules laid down in Ghana versus Murray, 1904. This is the end of study section 10. Thanks for listening.